I would never invest in somebody that's not full-time in the business and has a team. You got to be full-time, because why would you invest in somebody who's not full-time? Don't get me wrong, I respect everybody who's trying to transition, but if you're not full-time, I don't want my money being with somebody who's not totally focused.
In this episode, I talk with Alix Kogan. Alix is a seasoned real estate professional with over 20 years of experience and $500 million in transactions under his belt. He is the president of Ashland Capital, as well as an active investor and operator in over 2,000 multifamily and student housing units. We discuss his transition from construction and small portfolios to multifamily and student housing, how student housing is different than multifamily investing, how to properly mitigate risks with student housing, especially when you're renting by the bed, talk about the student housing market, and also the real estate market in general. I hope you enjoy. Now on to the show. How's it going, Alix?
Going great, Chris. How about you?
Good. Thanks for coming on. I know we had a scheduling hiccup with illness last time, but glad to have you on now. And we connected, I think it was on LinkedIn originally, and we've got a couple mutual connections after we spoke. So you've got an extensive real estate background, and happy to have you on and talk about everything you know. Specifically, we'll get into some things like multifamily, also student housing. But first, you got your real estate start in construction, right?
Yeah, pretty simultaneously with construction and development. But yeah, I grew up around a father, brother that are builder developers. So it was in my blood, although truth be told, I swore not to follow in the family footsteps, and I was gonna, do something different, and I did, and I was, in my 20s, I wanted to save the world and teach high school, and so I had a short stint of that a lot of people don't know about, and so that was a complete departure from the family business, obviously.
But gravity pulled you back.
Yes, gravity pulled me back. I enjoyed my interaction with high school kids and all the relationship building. I hated cramming information down their throats. Truth be told, I was starving at $26,000 a year, my salary back when I taught. So all those things sort of slapped me on the head and said, hey, maybe you shouldn't run away from something you actually love and passionate about and grew up around. Maybe you ought to go back to it, and that's exactly what I did.
Love it. So you ended up building a pretty sizable construction company, and then at some point you decided to exit. So what was the reason to wind that venture down and move into your next evolution?
Well, it was kind of twofold. So while building, the construction company I founded in '98, took off like a rocket ship, and we doubled in size for many years until we were the largest in the region.
And what time frame is that? That'll be helpful for context.
Yeah, so I started. I guess it was early '99, '98, right
Okay.
around there. So that's when I founded my company in Southwest Colorado. We built and developed around the Durango, Telluride, Southwest region, about a 2-hour radius. So the company
that was,
grew.
and so in the market, that's kind of when the housing construction the boom was just really starting, right? It really kicked into gear in the early 2000s, all the way through '08.
That's right. Yeah, so it was a great time to start. It was a really successful venture. I was super passionate about it. It was a design build firm. So ultimately we grew to be vertically integrated with architects, designers, the whole construction crew. I was lead designer and led our design team, and of course did everything else being the principal, but loved it, loved every minute of it, had an incredible 20-year run. But along the way, almost immediately, I started doing some development work. I was making a lot of money on a construction company, lived under my means, took that capital and started developing, doing small multifamily infill projects. some land entitlement, some vertical construction, subdivision work, townhomes, condos, some mixed use, a little bit of commercial. So that took off, and then so you have the two entities, so to speak, making money. And I took all that capital and then started buying existing assets, buying rentals, um, college rentals, what we called it back then before it was student housing. Started buying conventional, really anything that produced cash flow that I could get my hands on. So the evolution over 20 years was building these two businesses plus a personal portfolio. And then I realized that I built a monster in terms of the personal portfolio that we were self-managing. My CFO led that effort, and we realized we have a business within a business, and it was crazy, chaotic. And I made a decision to sell the entire portfolio because of that, and that was one of the pain points. I knew that it was time to scale into larger institutional assets that we actually didn't have to manage, as long as I could find good third-party partners to do the day-to-day, and we could asset manage them. And then the other pivotal moment is I had a kid, my only kid, our first kid in what was it, 2015, and decided we want to raise our kid back in Chicago. So closer to family, better schools, et cetera. So had a great run in Colorado, but in about 2017, we moved back to Chicago, and then I sold the construction and development company. I sold the whole portfolio, and as I mentioned, transitioned and pivoted into larger scale apartments, and that's when I really started bringing in outside money. Prior to that, it was my own capital, a little bit of family capital, and then we started syndicating and bringing in friends and family, and again, took off pretty quickly with a lot of people wanting to partner, and so that's it.
So what was it exactly that moved you from going into the institutional type assets? And by institutional, I think you're just referring to larger assets that, I mean, they take teams to run. So multifamily, an individual is not going to run a 200 unit multifamily or student housing communities. What made you move into those assets as opposed to just replicating what you did back in Colorado, where it was smaller units or single family?
So two things. Number one, I knew I was moving back to Chicago. I did not want to buy and build a portfolio in Chicago. Chicago, unfortunately, had its issues back then. Not that there's not opportunities everywhere, there are, but I saw opportunities elsewhere outside of Chicago. So I was strictly moving back to Chicago for family reasons. And I thought that the opportunity was to scale a business in growing markets with population growth, employment growth, everything that all of us in the industry talk about. So that was the primary reason that I decided to buy larger assets, because if they're large enough, I don't have to be there every day. I could have a team of great asset managers, which we do, that came from property management, and they know what to look for. They know how to work with on-site, and they're doing that on a daily basis.
Yeah, the scales of economy could, afford that team versus a single family buying that, out of area, out of state. You can. It's just the economics are pretty difficult, or you're really not going to make any cash flow.
That's right. And in essence, I just saw more upside with larger apartment communities that had a lot of liquidity, a lot of demand, versus scattered sites, single family and small multifamily.
Yeah. So, all right. So you're in Chicago and you're moving into multifamily student housing. Is this mainly as an owner operator, or is this as a passive investor, like an LP?
No, I mean, I've always been an LP for 20 years. But no, the Ashland Capital, that, evolution from my earlier companies, we buy, we own, we operate. And when I say operate, it's really truly what I call a hybrid, where we're working with the on-site. We do technically have third-party property managers, but we're mostly
the asset manager.
Yeah.
You're structuring the deal. You're putting everything together. You're putting the team together, and beyond that, it's asset management.
It is. But I'd say, I think one distinction that I'm proud of, that I think we do a little bit differently than some, is that, my guys, my asset managers came from property management. One of my guys came from Blackstone. We are working directly with the onsite with, we have a dialogue every day with the leasing manager, the property manager, the maintenance staff. It's almost like, we are the third party, or I'm sorry, the property manager, but underneath the platform of a different property manager. And it's a little bit more hands-on. It's a little bit different. It could be taxing, but it's the only way we know how to have a really good handle on our assets, other than truly being vertically integrated and having our own accountants and support staff.
Do you feel that as a LP, so you mentioned you were an LP or passive investor in these type of assets years prior, do you feel like that helped you become a better operator? And I'll just preface it with this: a lot of folks that do get into multifamily, especially if they came from the single family background, they go in head first as an operator first and then passive second. You're the opposite. I mean, you were an operator in real estate. It's just not necessarily a multifamily first, passive, and then went into operations with multifamily second. Or correct me if I'm wrong there, but
so we were self-managed for many years of all the assets that I own personally, but they were smaller assets. So I knew what it takes. I mean, it's basic blocking and tackling. For some reason, I was actually a bit intimidated by larger assets. So when we started buying larger 100+ unit communities, I did not want to self-manage them, and then naturally they were in different geographies, so it would have been more difficult. So when I started investing as an LP, I was still literally managing smaller assets, but I invested in larger assets. I thought it was much more complicated, and therefore I became an LP in a lot of those deals. But truth be told, once I was an LP, I realized it's not that different. It's just a few more beds, basically a few more zeros. And I think that just gave me a lot more confidence that, I invested in some good sponsors, and I invested in some that were average. And it certainly gave me a lot of confidence that if they can do it, with my background, I could do it. So, that allowed us to then obviously scale the business and not have any kind of concern that we can do it.
Yeah, and I would say, having that experience being an asset manager and a property manager, because you were self-managing your other portfolio, like that experience definitely parlays over into multifamily. Fundamentals are largely the same. It's just there's a few more gears that turn, but definitely parlays in, and you understood the value of team building. I think that there's an operator in Houston that I don't know all the details, but you probably heard about it recently, got foreclosed on. And then I heard like he's a team of one. I'm like, what the heck? Like, how can you have 2,000 units and be a team of one that clearly is in over his head? And then the property manager, didn't realize how to manage the property manager or whatever, because it seemed like it was a really downhill track for them. But you had that experience, you knew what to do, and then now you've got institutional folks on board on your team that really know the property management game, which makes them be a better asset manager.
Yeah, absolutely. I mean, that's the difference. I think back about everybody that I ever invested in were full-time legitimate firms, and some were better and some were mediocre, as I said. But to your point, the poor guy that everybody's jumping all over in Houston, and I don't know him, I don't know what the circumstances, but everybody certainly is using it as an opportunity to jump on this guy. I will say that I would have never invested in, nor would I today. We don't have a certain deal flow. I still invest as an LP because I want my money always working for me. But I would never invest in somebody that's not full-time in the business and has a team. So you got to be full-time, because why would you invest in somebody who's not full-time? I mean, don't get me wrong, I respect everybody who's trying to transition, but if you're not full time, I don't want my money being with somebody who's not totally focused. And then secondarily, if somebody doesn't have a team, what happens when they get hit by a car, right? What happens if they, God forbid, right, something happens, the business stops. And I don't want, a lot of my family's money is in our deals, my friends, extended family, my network. Something happens to me, I want to know that I've got a team that's a good steward of everybody's capital. So it is amazing that I hear the stories that you just brought up in Houston and many others that are just not set up to be a serious business. It's like, it's shocking to me. But anyway, that's a tangent.
and there's a lot more details to that. So I think it would be a good wake up call for LPs to take more responsibility and due diligence as opposed to throwing their money at an IRR, and then for GPs to step up their game in fiduciary responsibility to their LPs. So that I hope is the positive outcome of that, and hopefully he's able to dig himself out of that mess. Student housing. What brought you into student housing? Because anyone, what my initial reaction, and it's by full admission, lack of education, because I'm not that educated in student housing, but I'm always a little apprehensive when I hear it. But I do see a lot of opportunities with student housing, and you've mentioned some. What brought you into that? And then I will follow up with another question on the student housing market.
Sure. I guess what started was my experience as a college student renting from one of the most horrible slumlords in town.
Oh man.
I just remember that dynamic being so painful because he had a captive audience. There's only a certain number of houses, or today we call it bedrooms in a market, and there's a certain number of students. It's an efficient market, meaning everybody's going to have to find one, and sort of equalizes itself.
Yeah.
Which is different, in multifamily, you can decide to go to another neighborhood or this and that. It's not as efficient. So I think of it, it's like a fishbowl, right? And you've got a certain amount of fish in that bowl, and they're all going to find their path. So it was frustrating that the slumlord just knew that he could basically do whatever he wanted because we just didn't have a lot of options. And he had 10 more students that wanted to rent from him if we did it. And so fast forward to a year or two after I started my company in Colorado, I started buying college rentals because I said, look, it's not that complicated. They're actually a good renter if you know how to deal with them and if you can plan around all the issues that you have with college students. So I still, it's not easy work, but I enjoyed it. We were able to grow our scattered site student or college rental is what we called it back then, portfolio, and it did great. Fast forward to around 2017, 18, when I started selling everything, and I realized that there was this whole institutional class of student housing that's actually rented by the bed. I was still renting by the house to college students. It wasn't furnished. It didn't create a lifestyle. So that just has evolved over the last 10 years. And it's really become, something that you would probably equate more to like running a senior housing or assisted living asset. You're creating it's a service. It's not just a home, so you have to create a lifestyle, events, all kinds of things to do it successfully. So I love it as an asset class. I would say that I'm lucky because I partner with a guy has 25 years experience in the business. And then ultimately his number two guy ended up leaving property management because he wanted to be on the ownership side, came to work for us. So we're still using my friend who's an expert, but we also have expertise in-house. Where I'm leading with all this, if you have that kind of expertise, it's a fabulous asset class. If you don't, and you just sort of blindly buy assets and then hire a third party, it could be a nightmare. And we've actually have bought a couple of opportunities where it's conventional guys thinking that student housing is no different than conventional. They fail miserably. We buy their asset and turn it around, and it's been great for us. So you have to go into it eyes wide open. It's very dynamic. Markets change, schools change. So you have to be on top of it. It's all driven by enrollment. And then enrollment is driven by the academics. It's driven by the school's 10-year plan. It's driven by sports programs. You could have a bad something come up in the news that some football coach did that was horrible, and all of a sudden you've got enrollment decline. So the reputation management. My point is, it's a very dynamic asset class that you just have to be in real time measuring constantly.
Yeah. Now, when you talk about renting by the bed, is that like you have a 3 or 4 bedroom property and you're renting individual rooms, or is this more dormitory style where a room will accommodate 1 or 2 students and you have like community bath, shower, toiletries?
Yeah, good question. So when we say renting by the bed, it refers to by the bedroom. So all we do is private off-campus housing,
Okay.
which really.
And they're single family or like small
They're
multifamily?
all. I shouldn't say they're all. We have both in our portfolio. We have the equivalent of a Class A apartment building, and you've got anywhere from a 1 to a 5-bedroom apartment.
Mm-hmm.
But the leases are signed per student per bedroom.
And do you segregate that by gender, where it's like all males in one and whatnot?
It's a mix, because there's basically a property management software that pairs people up. So if they have a gender preference, they'll state that, and we'll have to pair them up. So there is a matching and pairing process. And then, of course, once they move in, there's also some occasional mediation efforts.
That is my immediate fear jumped up there is in a co-ed situation, which there are co-ed dorms, so it's not like this is a unique situation. But my immediate fear is co-ed situation. I get a call, there's police, and there's like a rape investigation. Like that's I don't know, and that hopefully you've never had to deal with that, but. Mitigating that type of risk, like how do you have that discussion with your insurance and your legal team?
Well, you have to know your legal rights, obviously. So we've got counsel at our disposal constantly if something does come up. Fortunately, those kind of crazy incidents rarely happen. But you have something that comes up. It's typically 2 roommates that don't get along. One's eating the other's food. One of them is smoking. One of them's
a lot of childish stuff.
Yeah, it's typical college stuff. So we rent by the bedroom, mm-hmm. and there's a matching process. It doesn't always happen that way. Oftentimes you get 2 roommates that want a 2-bedroom. They come in together, or you have a group of 5. You've got 5 sorority girls that want to rent an apartment together. So there is a lot of that happens. So that's the one sort of typical type of asset. It looks and feels just like a highly amenitized A-class apartment building. There's gyms, there's pools, there's study rooms. I mean, you name it, our assets have it. It's crazy what college students are living in today. By far, much nicer than anything I ever lived in college or after college, actually. And then we also have a product that's a cottage style, which is really equivalent to like a BTR, built for rent, single family home community, but it is designed and built for college students exclusively. And that's been a really popular product. Same reason, that where a family may prefer a single family home, a group of college students prefer to have a single family home. They might have a dog, they want a little yard, etc.
Yeah. So what unique things do you look at when looking at, say, a large student housing community versus a multifamily?
You mean what's the different evaluation process?
Yeah. I mean, from an underwriting standpoint.
Sure. So it's a whole completely different set of underwriting metrics. I mean, we're looking at the obvious. You've got a lot more turnover, so you have turn costs. It's I think the obvious one that people are fearful of is you have a limited window to lease up to get all your residents in for the fall,
Yeah.
and then you're done. There's not a lot of backfilling that happens. There's some, but not a lot. You have second semester students come in, or a late enrollment, something like that. But you got to really by July, mid-July, you better be fully leased up, or else you've kind of missed the boat. So that's a whole nother. So when you're underwriting, when you're buying that asset, where are you in that process? What's the pre-lease like? So as we're underwriting deals today, if we're looking at a deal and they're 30% pre-leased and we're going to buy it today, and we're in April, that's a bad sign. We'll probably not get to 95, 96% occupancy by the fall. That's a problem. So if I'm going to buy that asset, I'm going to buy it at a severe discount. So those are some of the metrics that we look at. I mean, probably the biggest things in terms of underwriting and evaluating an opportunity is you start with the school, which is no different than multifamily. You're starting with the market. How much do we like the market? Is the school growing? And how is the asset positioned within the market? Are you pedestrian to campus? Are you within a mile of campus? Are you A class? Are you B class? So some of the kind of higher level analysis is the same, but the details are different, if that makes sense.
Yeah, 100%. I was talking so I went to Texas A&M, and I was talking with some other Aggie grads at our kids' football practice, and we were just talking about the attendance numbers. And I did invest in it while I was at A&M, but I never bought a property in Bryan College Station. It was always San Antonio because they were online. From my dorm room, I could find them, and I just couldn't find anything in College Station. But man, I wish I did. Given the attendance and also just the development they've done over the years. But if want to flip over into maybe just the market for student housing. So I mentioned my first apprehension is, besides just lack of education, it's been more the risk mitigation from a tenant standpoint or management, but also on the market, because there's been a lot of talk and a lot of government talk about like the student loan bubble. And really what's driven these college campuses to the ginormous sizes that they are now is a lot of loose money with student loans. And when or if that bubble ever bursts, how does that impact these mega universities or even smaller universities? How does it impact them? So what's your take on that and how that relates to the housing market or the student housing market, or how that would affect it? If, I'll let you run with that.
Sure. There's been a lot of talk, and fortunately I just got back from the National Student Housing Conference in Austin last week. The sentiment in general, and I'll get into details why, is very strong for student housing. The rent growth has been tremendous. All the student housing owners, operators are very bullish. However, there is a consolidation going on. So the smaller schools are struggling. And I even use that loosely, because you could be a small school, a private school with affluent students and be doing very well. Like take a Wake Forest, for example, small school, but attracts a lot of wealthy students. When you have that kind of dynamic, student loans are less of a concern, because their parents have put money away from them in their it's the 401, 501 college fund that I have for my kid. I can't remember the name of it, but the money is set aside. They have the affluence. It's a rite of passage. They're going to go to college. It's part of the family. It's part of just the culture. So there's those schools are going to do fine. The smaller schools that have less focus on academics, less focus on sports, they are suffering, and people are not seeing the value in going to those schools. But what's happening is, if they were going to go to school, C, that's mediocre, and they've decided not to go to that school, they're going to shift over to school A, that is a larger state school, has a great education program, great sports program, and those are thriving. So the deck is kind of getting shifted, if you will. in terms of where the students are going. It's schools are like a business. If they need to grow their enrollment, they have levers that they can pull. It's increasing the enrollment requirements or lowering the requirements, so they can throttle that stuff up and down. And they'll find a certain amount of student loans and aid within their system if they need to. So we're less concerned that the student loan dynamic is going to affect the good schools. It certainly can affect some, but it's not something that the industry right now is terribly concerned with.
Yeah, so really just similar to multifamily or any other real estate, it just goes down to knowing your market, and your market is heavily, or knowing your market, but also knowing the jobs. Like you're looking for jobs. Now, in your case, you're looking for schools. So it's knowing that very well and understanding the macro micro trends that they're going forward before you invest. So I would definitely agree. And the government's definitely very, very vested in continuing a gravy train for student loans. How this shakes out, I don't know. Before we got on this, I looked up. It was like $1.8 trillion.
Yeah,
1.8 trillion. And I firmly believe, this is just my belief, like it's changing, like old school, the way of learning, and which means universities have to adapt too. It's not like a university podcast, but things are changing, and the schools that don't adapt quick enough, they may find themselves more irrelevant, which is going to hurt their enrollment. So but the larger universities should be more equipped or better equipped to do that.
Yeah, absolutely. I mean, during COVID, the big conversation was, are people just going to go to school online and not, go to school in person? Mm-hmm. And that proved to be not the case. It works as a hybrid. It works if you have a pandemic. But, the polls of students after the pandemic, would you go to school online if you had the choice, is no, because you go for the social aspect as much 100%. As educational. And I don't care what anybody says, educationally even, you do not get as much out of it doing this versus in person with other students, with dynamic professors. It's just a different experience.
So and depending on your major too, it's like you typically don't get the street education for your whatever your vocation is. I know I did, other than learning how to use Excel for statistics and how to make a PowerPoint presentation. Like those are the two educational things I learned. Everything else was social, and that is invaluable.
Right.
But of course, if you want to go into STEM, you're probably going to learn a few things that you might need in the street.
Yeah, I was going to say STEM. There's a big focus on STEM, and you can't replace being in person with that. And I think our country is realizing that there's other countries that have left us in the dust in terms of math and science, and so we need to shore up our education system that we can compete. And, the only way you can do that really is in person.
Yeah. So what's your take on the real estate market in general? We're going through some cloudy skies, and just the whole economy is kind of like, are we in a recession? Are we not? Are we going to be? What's the Fed going to do?
It's a crazy time. There's no question. It's, the obvious, I'll just say it, but you've heard it 1,000 times, the bid-ask spread and sellers wanting yesterday's pricing while we're only buying at today's price. Yeah. But, having said that, we're still bullish on it. We're much more cautious, when you don't have cheap money, when you don't have markets just, going through the roof and rent growth that's insane, you have to be naturally much more careful. You've got to buy the right asset, the right market, and you have to have the right expectations of rent growth. You have to have the right debt structure. You can't, you can do floating rate debt today if you are confident you can execute your business plan and get into permanent financing and all your expected metrics pan out. Sure, you can do it, but it's not something we're doing anymore. So I am overall bullish on the market. Our country needs housing. You just want to do it in places where your odds are significantly increased because population is growing there. There's good employment, and you're buying the right asset. There's for us, I'm speculating a lot less. I'm not just saying, hey, I'm going to buy this. I'm going to throw 10 grand a door into, cosmetic rehab, and I'm going to just push rents $300. I'm not making those kind of bets. I'm much more conservative. I've always been a conservative investor. So we're looking at less of a lift, less of speculation, and more of, look, here's the cash flow. We can increase that cash flow some, but let's not get over aggressive. And if we have to get aggressive, we're just not buyers. We're not a fund. We're only going to buy when it makes sense.
Yeah, and that's kind of the approach that I've been taking, and I see the projections that are still coming through. That, I mean, they're very rosy, and while it may be possible to hit those, it's just at the end of the day, I want to know, like, hey, if you have to hold this thing for 7 years, does that make sense? Can you actually do that and still meet your metrics for your for the LPs? Versus the short-term game that has been played over the last few years, the 2-3 year refi, selling 4 or 5, or selling 15 months. Like we did that once, but it was still a 5-year game plan, and it was on fixed debt. So we had the ability to hold much longer. It's just the market gave us a good deal, and you take it.
Sure.
So you're still buying, being a lot more cautious, being definitely cautious in projections and operations, which I guess that'll lead me to the last question. It seems like, and I've seen this from a lot of analysts lately, is the market has been able to push performance very heavily over the last few years. Performance now is going to be primarily met by strong operations and typically with budget management. How are you able to budget properly to maintain your income and increase it as necessary, but also cap your downside, cap your expenses? Because insurance, taxes, and labor materials are just skyrocketing. Any thoughts there? Any advice there for other operators that they're starting to shift their game plan to shoring up the ship?
Yeah, I mean, I think if you own assets, it's a lot easier to look at those assets and find where there's a little bit of fat, where you could trim and cap your expenses. There's so many different little levers that you need to look at. And that's a real-time monthly sort of evaluation. You could have a seasonal dynamic where you've got to put more money towards X, and then a different season, you could scale back some of that expense. So it's really, again, we could talk for hours on that, but it's a very granular, real-time analysis of expenses. I'm not going to bore you with all the typical stuff, your utilities, management, and all that stuff. I would say the biggest thing that operators should be looking at, which I don't believe that many were in the last several years, is I don't think they're doing good diligence up front on your costs. So where insurance costs are unpredictable today, they're all over the board, and they're different from, like we're buying an asset in Louisiana at LSU that we're closing on in 30 days. The insurance being a cat area is insane, and it was almost a deal killer. So don't guess, and make sure you're getting insurance quotes. Make sure you're hiring a professional to do a tax study. We do a tax study on every deal that we buy. We don't just say, gee, let's get on the county website and look at the mill rate and let's just guess. We're not experts in tax analysis, but the national firm that we use, they are. And I'd rather pay a couple $1,000 to ensure that I know my worst case, my best case, and my base case of insurance. So a lot of those things I think are not being diligenced right up front and underwriting for it, as well as CapEx. Guys are just saying, hey, it's an average of 10 grand a door. Well, have you checked, viable vendors today in your market that have validated with us with hard number bids and multiple bids? that's probably my best piece of advice right now in the market that we're in, because we can't afford to be wrong, right? We can't afford, because we're not going to make it up on rent growth, right? We're going to plug in a very conservative number. So I'm not going to get it on rent growth. If I do, great, but I can't depend on that on the front end. I've got to have all my numbers set.
Yeah. That way, if you do get the positive rent growth or about more than expected, it's your LPs are happy with you. Not that you came in a little bit below and they're questioning why the return's lower than expected.
Yeah. And the other thing, I think expectations of returns. We've all been spoiled, and I've told our investor base, I mean, our portfolio track record is exceptional, but I keep telling them, do not have those expectations going forward. And I feel like that's okay, because we're still in an asset class that's very tax efficient. And, there's other things you can invest in that might be ordinary income rather than long-term cap gains. Are you going to be in the market? That's volatile. It's not for everybody. I'm not saying don't invest in the market. I invest in the stock market, but the majority of my wealth is in real estate. So I'm okay saying, hey, if I was, doing an average of 15 IRR in the years past, I'm okay with 13, because, it's still a great asset class, but let's not have unreasonable expectations.
Yeah, that'll be interesting to see how just LPs get because you're educated through experience, through opportunities and all that on, hey, these are what these opportunities should be performing at. So it's almost like from a GP perspective, if you're putting out something lower than that, like it's already harder to raise now, but even though you may be honest, it's going to add some extra headwinds on the raise, and how did they react to that? So it'll definitely be interesting to see how LPs react to that. But at the end of the day, when they go through a few cycles and see it in real time, they'll get it.
Yeah, I mean, the thing that I've been hitting, we've just raised for a couple of projects successfully, knock on wood. And my LP said, well, why are you in this 13, 14 IRR range? I said, I'm in this range because I'm assuming that 4-5 years from now, interest rates will be the same as they are today.
Yeah.
And they say to me, well, that's probably unlikely. They'll probably be a little bit lower. And I say, I agree with you. And if they are, your IRR will be not 13, 14, it'll be 16, 17. Are you okay with that? And they're like, oh yeah, great. Well, so it's an education with our investors saying, we're projecting this because we're not, projecting interest rates will be lower. If they are, that's an arbitrage, because cap rates will come down and we'll be able to do better. But let's just be conservative. If all things are equal, we'll be in the lower teens rather than the high teens.
Yeah. I say 12 plus with my fund. It's like, I feel comfortable, exceeding that expectation. So moving on to these final 4 questions I asked to everyone that comes on the show. So closing this out with the first question: you could give advice to your 20-year-old self, what would that be?
Take the blinders off and realize that there's more opportunities. I just thought very, very narrowly in terms of investing in businesses, and there's a lot more things out there. So I think just think more broadly, look at more opportunities, and take off the blinders.
Love it. What book or books have greatly influenced your life?
Oh God, I don't have one.
Or maybe a podcast.
Yeah, I'm just an active listener of all different kinds of podcasts, not just real estate related.
Mm-hmm.
I like a guy like Sam Zell, obviously made most of his wealth in real estate, but he understands the economy, understands business. So I really like podcasts that are a little bit more holistic. And then, I listen to plenty of stuff on nutrition and exercise. I'm 53 with an 8-year-old. So I'm focused on being as healthy as I can be and keeping up with that little dude. And so, I want to make sure my business is healthy, but my state of mind and my health as healthy as possible as well.
All right. In the last 5 years, what new belief, behavior, or habit has most improved your life?
The last 5 years? More focus on my health and my family. I was a typical entrepreneur for 20 years with my head down, doing whatever it takes to drive that business. And in the last 5 years, I've looked up and certainly I've realized if you don't have the health and the family all in check, then what's the business for?
Yeah, it's a stool, and you can balance a one-legged stool for a little while, but not forever.
Yeah.
How can people reach out to you?
So my email is Alix with an I, ALIX, at ashlandcapitalfund.com. And of course, the website is ashlandcapitalfund.com.
Awesome. Thanks for coming on, Alix, and look forward to talking with you again soon.
Awesome, Chris. Thank you. Good to be with you.
You too. Take care. Thanks for tuning in. If you got any value out of this at all, please like, comment, subscribe, follow. I'd love to hear from you. And for more real estate related content, market observations, upcoming events, you can go to investedx.com and subscribe to our weekly newsletter. I promise you won't regret it. Thanks again.